Hey, welcome back, guys. This is your host Rohit Sawant, and you're watching Auction Market. This is my channel name, and the official handle name is Auction Market RS. So, hope guys, you all are doing great today. So, what will be your today's agenda? Okay, so let us discuss. We'll focus on the key areas. Okay, the different zones, the market flows. Okay, why does the price move? This will be our topic for today. What exactly happens, what exactly initiates the price? This will be our topic. Okay, before we move further into deep details, what moves the price? Okay, what do you think, according to you? If it is a green color, it moves the market. If it is a red color, it moves the market. What exactly you guys think on it? Or the people who come on newspaper or television, they often comment, and because of their comment the market moves. So I'll just brief off the things before we get further into the details and trading setup. Was your answer because these are because of the buyers and sellers? So do you think because of buyers and sellers the market move up and down, or vice versa? No, this is not the thing. Okay, so what truly moves the price is the aggression. So in the previous video, I have already made some clarity on aggression. What exactly moves the market? Okay, initiative buyers, initiative sellers, fair value area, fair value gap. Okay, so what exactly moves the market here? The price aggression, the seller aggression, the buyer aggression. Okay, so if the price goes up, then the buyers are more aggressive. If the price goes down, then the seller are more aggressive. Okay, let me go to the next slide. So what exactly moves the market here? Okay, so I have told you we have four players in the market. One is limit buyer, one is limit seller, and one is market buyer, and one is market seller. So market order or market players, moves the market aggressively upwards or downwards. So if you're aggressive and you want to buy or sell now, if you want to do something now, okay, just be 100% sure that you need to use the market order. So market orders are the orders which you punch for that particular respective instrument. So take an example, Nifty is one of the instrument. Nifty is trading around 24,000. Okay, and you punch an order at 24,000. So that particular drives that particular market. Getting, guys? These types of order means that whatever price your order will get filled for that particular instrument or for that particular available price, you punch your order. That is called a market order. So market order is one of the player who has uh, the power to move the market upside or downside. Okay, limit players are just they act like a sleeping partner. Like whenever the price comes over that particular limit range, it just get executes. It will not drive the market. Okay, so take an example. If you have, okay, 1,000 lots in the Nifty, 1,000 lots. So what exactly big players try to do here? If they place 1,000 lots in one go, they cannot place all the 1,000 lots here, as you can see in the screen here. So initially what happens is like you go for 100 lot buy, next candle forms like for 200 lots of buy, the next, and it goes on until that particular 1,000 lot gets filled. So slowly and steadily the market moves up. Why? Because in one go, we don't have enough sellers or buyers for that particular key zone. So that's the reason the price moves up slowly by averaging the price in the upward direction or downward direction. Okay. So imagine a situation where the price of the Nifty will go up. So you are a hedge fund trader, or you are an HFT, or you are an investor, foreign investor, and you want to enter long with 1,000 lots. But unfortunately, everybody else sees this piece of news and they also want to see the opportunity. The price is starting to go up rapidly and you want to be a part of that. Okay, and you really want to enter your positions. However, this is happening very fast. So this kind of activity happens too fast. You cannot actually enter in the desired position. There will be a slippage. If you want to enter at 1,000, you won't get that exact 1,000 positions. There are high possible chances your order might get punched to 105. So make sure you will be jumping into that particular trade, but there is a huge risk also, slippage risk. If you're punching an order on 1,000, trading at 1,000, so there are high possible chances your order might get placed at 110 or 105. Okay, as you can see in the graph here, particular buying lot is at 100 lots, the second buying lot is at 200 lots, the third buying at 100, and so on it goes on. So wherever you get enough positions, limit sellers are available, so that particular position is getting filled and the price is going up. Okay, let's go to the next slide. Because the position is pretty much very big, it won't be filled at once. Okay, this I've already explained you. It will be get filled fast. You will be able to enter the whole position, but the position will get split as the price moves upwards. Okay, so it is aggressive market participants who drives the aggressive price upside or downside. This is the true reason behind the price movement. Getting, guys? It is the aggressive nature of the buyer or aggressive nature of the seller with the market order he punches that makes the market drive from one volume area to another volume area. It is not the limit players, it is the market players who drives that particular market. Okay, so the next question is, who moves the market? Okay, so basically the retail player cannot move the market because he has a very limited capital. Take an example of the forex market only. Okay, or you can see the list of institutes who has the capacity to move the market from one position to another position, or from one volume area to another volume area. Okay, Citibank, Dutch Bank. So these are the big players in the forex market who has that capital to move the market from one volume area to another volume area. Okay, so how do you try to capture these big moves? Okay, as you can see, we can't move the price, we cannot manipulate the market as well. Okay, but we can be profitable here. How that is possible? How can a retail trader be a profitable? We only need to accept our role in the game. Okay, to be a profitable, we need to keep an eye on the big guys. So how to keep an eye on that particular big guys? How do we know like who is entering into the market and who is exiting from the market? Okay, I will explain in the upcoming slide. How do we know that? Okay, how do we track those institutions? We track them through a price action and volumes. So this is a behavior. Price action is one of the behavior, and volume is another uh, byproduct of that particular price action. So you can hide a price action, but you cannot hide the volume. Volume will make sure to highlight those particular key zone areas. So if someone is trying to buy a 1,000 lot, definitely that particular 1,000 lot footprint is being highlighted in the volume. You cannot, you know, hide those particular footprints. Footprints can be hidden only in a smaller or a sideways price action where the market is sideways. But as on the particular volume increases, he tries to punch more and more lot for that particular key area. It will definitely get highlighted in the volume. Okay, volume provides us the clue on what the institutions are doing. Okay, what they are doing right now and what they are likely to doing in the future. So we have to keep an eye on the price action, and for that particular price action, volume is the tool which will help us to identify those key regions. Okay, I'll move to the next slide. Will indicators help you? Guys, I have tried a lot of indicators, the moving averages, the Bollinger Band, and there are a lot of indicators which are available on TradingView and some other charting platforms, but none of them will give you the 100% result. So standard indicators, what exactly they do, they try to capture the historical data. Okay, standard indicator only shows you the historical failed or success data to forecast the future movement. I don't want to go into the mathematical calculations here, but if you look at how the common indicators calculate is like, you will see they will only work on two variables. One is time and one is historical price. Okay, these are the only two parameters what they use. One is time, one is historical price. That is nothing more. All these indicators are only showing the variations and different visualizations of time, what exactly happened for that particular time in the past, and historical price for that particular price action. There is no holy grain. you know it cannot be 100%, it can be only 50-50 opportunity. So that is what it tells. In trading there is nothing certain, it will be an uncertain situation only. So that's the reason you cannot rely on the indicators 100%. But when you talk about the volume and the price action, yeah, there are high possible chances where you can depend on it and capture that particular institution movement along with them. Okay, so how to spot those institution activities with the price action? Okay, so there are basically three significant approaches what we follow in the price action. One is the sideways price action behavior. Second is the aggressive nature of the behavior. Third one is the strong rejection behavior at the lower, at the bottom. Okay, so we'll start with the sideways price action. So in this particular slide, you can see the price is getting accumulated in the sideways zone, the highlighted area, the box, the blue color box area. Okay, so what exactly it tells you? The price is getting accumulated. Let us show you that proof that a big positions, trading positions are getting accumulated in the sideways direction. The picture below shows exactly the same chart what this time the volume profile shows you. So along with this particular accumulation, if you have the side profile volume, okay, you can see in the chart, it will help you to mark those particular key zones. So in the next time when you try to enter any positions, you have enough evidence of enough double confirmation to go long or short for that particular region. So with the help of price action, with the help of volume nodes, you can easily plot those particular regions. This is what I have shown you in this particular graph. Okay, so what exactly the summary of this is so look for the sideways price action, okay, in the chart ways. Those are very significant places because institutions are trying to accumulate their positions here. What exactly accumulation is like? They will not go long or they will not go short. Okay, so they will act like they are going long. So as soon as the retail trader tries to go long, he will short the position. So it will be in a particular range. It will not try to cross that particular range. Why? Because he cannot do that. If he tries to cross that particular region, his quantity won't get filled. So take an example, he is having 1,000 quantities or 1,000 lots. So in one go, he cannot fill all those positions. So what he tries to do is like he tries to average his positions very close to each other. Take an example, he tries to buy a lot of 100 at 101. Okay, so next, what exactly he does, he tries to capture 200 lots at a price of 105. So what he does is like within 101 to 110, he tries to average his price. That's the reason he try to accumulate the market in a particular zone. Getting, guys? So one of the biggest difference between the retail trader and the institution trader is that they don't have a amount, that particular huge amount what exactly this HFT has. Okay, institutions have a very huge amount which they are capable of moving the market, and because of this problem, having a big capital also, that is also a big problem, that you cannot show it in a one go. Okay, so that's the reason what they do, they try to hold their position in chunks, not in one go. So if they try to deploy all their capitals, definitely it will be highlighted in that particular footprint, the volume footprint, and the retail players try to enter in that particular trade. So in this kind of a situation, it won't be profitable to the big investors. So where exactly you can notice this particular regions? So you can notice this particular regions in 1 minute time frame. 1 minute time frame is the best time frame where you see a lot of accumulation happening, lot of breakouts happening. Okay, so if you go to 5 minute time chart, rarely you see something. You can see, but the high possible chances are in the 1 minute and 30 minutes time chart. Okay, not in 5 minute or 15 minutes. Okay, so I'll move on to the next slide. Hope you guys are with me. So second type of market what we see is like aggressive initiative market. Soon after the sideways market, they push the market in one direction. Why they push the market in one direction? Because they want to book their profits. Okay, aggressive initiative activity is basically a significant price movement. Okay, a significant price movement you can see over here in the chart. So it is caused by an aggressive buyers who tries to push that particular price in one direction, or a seller try to push the price in the downward direction. So this particular sort of aggressive buying or selling often takes place after a sideways momentum which is getting exhaust at one particular time. So once that particular positions are filled in the sideways market, accumulation is completed, the price is moved aggressively in either of the direction. So how do you decide in which direction the price is getting moved? So we have something called as delta, which I've already explained in the previous videos. I request you guys to go and check that particular video, how delta help us to identify the price movement. So I'll give you some brief explanation about when that particular consolidation range will break. So take an example, when the consolidation range starts, from that particular time to the end, you have to calculate the delta. So if the delta is coming positive, then the price will break in the upward direction. If the delta is coming negative, then that particular price will break in downward direction. This is the basic concept of when breakout will happen and in which direction the breakout will happen. Getting, guys? So we'll move ahead to the next slide. A strong rejection of either higher or lower price, which is sudden price reversal. This pattern is made when the price goes in one aggressive direction and comes back opposite to that particular direction. That is called a strong rejection or a strong reversal. Okay, so this is one of the third pattern, strong rejection. Price goes, aggressively in one direction and aggressively it reverses from that same position. A classic example would be a candle called a pin bar candle. Okay, so you see a aggressive nature candle or a reversal kind of a pattern using a candlestick pattern called pin bar. With the help of pin bar you can identify, but pin bar isn't the only visual. Every time pin bar you cannot see each and every time. Okay, for a strong rejection, so there are many strong rejection candles other than pin bar also, which we need to identify. What happens in one side of the market? For example, buyer is aggressive and moves the price in one direction. Okay, then it clashes with the other side. Suppose, take an example, at 101 a buyer buys and he moves the price to 150. So 150, we see already a limit seller has taken a position over there. So he will not allow the price to move above 150. So what he does, from 150 he tries to sell those particular positions aggressively in the downside. So limit players are very important. So they will not allow the price to move at a certain range. Okay, and a strong rejection takes place. So the area where the other side took place is very significant because it is marked as a very strong market participants. So what the market participants are? It is called limit sellers. The course of action and the started counter move. So from that particular point, a counter move will start in the exactly opposite direction, and we call it as support or resistance, or support become resistance and resistance becoming support. This is the concept of strong rejections. Okay, this is the area where we can see a strong rejection happening. A price suddenly moves up and we have a limit seller at that particular key area, and that's the reason the price comes down suddenly. Okay, so guys, this was the basic concept which I have tried to explain in one particular slide. So in the blue color box you can see a price is getting consolidated. Okay, and in the light yellow color shade you can see a price getting moved upward very aggressively. Okay, from where the initiative start, initiation aggressive nature of the price you can see in the yellow color, and the strong rejection you can see in the green color. Once the candle goes up, a strong rejection comes. Why? Because we have a limit seller or limit buyer for that particular key zone area. That's the reason we see certain behavior of the price. As you can see guys, there always cannot be a pin bar. Okay, for a reversal there can be a some other pattern as well for the key reversal zone. The candle pattern doesn't matter, but you have to understand that particular key area where exactly the limit sellers are, where exactly the limit buyers are, and there are high possible chances the price will reverse from that position immediately without even indicating to you. So suppose, take an example, in the aggressive initiative pattern, uh, in the green color box you can see a green candle forming over there. So that green candle will be having 50k delta. Okay, but immediately the next candle, red candle, what you see, it will having only 20k of delta. So 20k of delta is enough to beat 50k delta. Why? Because there will be a question here, 50k delta, positive delta, how negative delta is trying to beat with the help of 20k. 20k is the market order and 30k is the limit seller who are already occupied in that particular key region. That's the reason we see a huge fair value gap in that particular region. So that's the reason market falls from that key zone. So thank you guys. This is what I had for today. So in the upcoming videos, I will try to explain you a couple of support resistance strategies with the help of volume nodes, which will help you to identify in the live market. Okay. So what I request you people is, like, I've seen people are trying to search for this particular channel, but in the analytics I can see you people are not subscribing it. I don't know what is stopping you to subscribe this channel. I request all of those people who are just trying to view the content but not subscribing it, uh, please subscribe the channel, do like and comment your thoughts on this particular content. you know it takes a lot of efforts to create any content and deliver it to the end user. It will help us to grow our channel, guys, as we started from the scratch. We don't have a big background like big players, so we are trying to build a community here and deliver as good as equivalent knowledge, which is very rare in Indian market, the auction market theory. People are doing the normal candlesticks pattern, which are not delivering the desired result. So with the help of the auction market theory, you can easily try to gain some sort of grip in the Indian market. So this is what I can request you people, uh, to please do like, share and subscribe with your friends, so that it will help us to grow our channel. uh, Thank you guys. It was nice talking with you. Hope you guys will show your love for this particular video. It will help me to come live and share the live trades which I take. If I get like more than 1,000 subscribers, it will help me to come live and share some more live examples, whatever strategy I use. So unless and until I won't get 1,000 subscriber, it is very difficult to uh, come live and share all those crucial data with you people. Okay, thank you guys. Take care. Bye bye. That's it for today.